Langmead. I'm the CFO of Puffin Produce and Pembrokeshire Creamery, and the chair of the Sustainable Scale-Up Cluster Advisory Group. So firstly, thank you all for joining this webinar, which is jointly hosted by the Sustainable Scale-Up Cluster and the Insight Programme. We'll be looking at the outlook for the GB economy and the implications for the food and drink sector. What can I say? I think we're facing some of the toughest times in UK food and drink at this moment. I think the inflationary pressures are coming at everybody who's in the food and drink supply chain. And I suppose I must stress the importance of getting a grip on your costs. I think that is the key to trading through the next 12 to 18 months ahead of us. It is very important that you get a review going, a review mechanism, because the costs associated of supply are changing on a month-to-month basis, and it is a very live environment, and it simply isn't a case of reviewing your costs and asking for a price increase once. It's looking at it again in a month's time, and 3 months' time, and in 6 months' time, because things are changing all the time. And it's very important as an industry that if there is an opportunity to work more closely together and to collaborate, then we take advantage of those opportunities, because the pressure that we all face is very real. And I'm sure everybody on this call is feeling that, because whether you supply the wholesale markets or the retailers, the responses and the reactions to requests for price increases vary significantly, from very understanding and supportive to, quite frankly, unreasonable. And that is a reflection of the challenges that the UK food and drink industry face. I think it's really important that you understand the cost of borrowing, and that is critical in terms of your planning and your budgeting, because interest rates are rising, raw material inputs are rising, distribution costs are rising, and all these component parts, when added together, can be a very significant number. And the importance of forecasting ahead and understanding those fluctuations in real terms now will be the defining point in terms of trading through this environment successfully. But before we start, I'd like to talk briefly about the Sustainable Scale-Up Cluster. The cluster is there to support businesses with tackling the challenges that we're facing in our industry. Whilst the cluster's name focuses on scale-up, the team also helps businesses with survive and revive. The cluster team members are steeped in food and drink sector experience, including scale-up, turnaround and startup experience, include accountants and finance professionals who can help guide businesses through these turbulent times. We'll add cluster manager contact details into the chat box, and if you would like to talk through some of the issues we're covering today, please get in touch with the cluster, because we're here to help and support you through these times. And then just before we start, a quick reminder of the usual housekeeping rules. Please keep mics on mute unless you have a question. Use the chat box or raise your hand if you have a question. And if you can leave your camera on, it's always better for the presenters to be talking to faces rather than black screens. So at this moment, I'd like to introduce Donald Webb and Anne-Harrod Butler from the Brookdale Consulting Group, who will take us through some key economic indices and explore the impact on our sector and consumers. And then Sophie Colon will offer some thoughts about the retailer response and what this might mean for our businesses. So welcome all, and thank you, and I will hand over to Donald.
Donald, you're on mute.
Can you all hear me?
Yeah.
Yes.
Yes.
Great.
Yeah.
Fantastic to be with you this morning, and thank you for your welcome, John. It's great to be here. We're going to take you through an economic overview firstly this morning, and just a few things that we'll go through, 4 things to be specific. Firstly, looking at the economy. Secondly, looking at shopper behaviour in response to the economic conditions that we have. Then a little bit on the out of home, that's OOH, out of home and retail markets and how they are responding together. And lastly, the implications for food and drink businesses. So back in March, we gave an economic overview. And at that time, I said there was the good news and the uncertain news. And I'm afraid I've had to change the title today to just the news. I think it's hard to find good news at the current time, and things have certainly been changing by the day. We were very interested to monitor the economy post-COVID. What was the recovery like coming out of COVID? And you can see from this slide that right on the far right-hand side that the UK economy has almost recovered from the COVID hit. It's very slightly below where it was in February 2020. And we say, well, that's good. But if you look at the rest of the G7 that are on the slide here, you can see that with the exception of Germany, they have all recovered much more strongly than the UK has. And the US and Canada in particular stand out in terms of their strong recovery post-COVID. Perhaps the United States was not quite as badly hit as we were, but it's up 2.6% on where it was pre-COVID. And that is the challenge for us. Investor confidence in the United States, higher interest rates, the US economy is motoring. This slide then talks about the UK debt. If you can work out the numbers, it's sort of 2.36 trillion. This is slightly dated. There will be a next announcement on the 28th of October, and we're probably expecting that debt figure to increase. And that's 99.6% of UK GDP. And I think you can see then why the markets were spooked by Kwasi Kwarteng's announcement a couple of weeks ago that we're just going to borrow a bit more. Having said that, if we look at some of the other countries in the G7, I haven't got a slide for this, but Japan borrowing is 221% of GDP, Italy 151%. We say, well, we don't go there for financial probity, we go there for nice wine and food and a nice sunset. USA 119% of GDP, France 93%, Canada and Germany much lower at 59% and 45% respectively. So the UK is definitely up there, but it's not the highest in terms of the G7 in terms of debt. What about unemployment then? And I guess you'll be facing these challenges in your businesses of trying to find people, 3.6% being the latest figures at the UK level, and Wales even below that at 3.2%. And of course, there was that peak during the financial crisis of 5%. We've seen it fall sharply since. And this is about 1.2 million people in this pool of UK unemployed. And of course, Brexit has restricted foreign labour and probably creating the most significant squeeze in the UK labour market in the last 20 years. But the other thing that's interesting is the economic inactivity is rising, and that's up 6.5% on pre-COVID. Now, there's lots of people in this category, about 9 million in total, but this includes, students is a good chunk of those, retired is a smaller chunk, those who are long-term sick. So there are some people within this pool that couldn't work, but there are also some that definitely could, and that could ease some of the challenges within the labour market if we could get some of this group, and of course this 500,000 increase in this group, back into work. What about job adverts then? Now this graph is an ONS graph on online job adverts, and we can see that massive peak middle of 2021 where companies were just desperate to get people, and look how that peak has dropped. Now, what does that suggest? Well, hiring is definitely slowing, but is that because companies are satisfied? Is it because the market is slowing down? Is it because they're more cautious? They're worried about what the market is telling them. And so we certainly can conclude from this that companies are not nearly so desperate to hire as they were in the post-COVID reopening. Interest rates, of course, have been really well trailed. They've been rising rapidly, but apparently not rapidly enough, because all the investors want to put the money into the United States where they can get better returns. Now, this was a projection from Bloomberg. This has probably pulled back a bit given recent government announcements, so we're perhaps not heading just for 6%. But of course, the spreads have widened, and so the base rate, 2.25%, is still historically low. but anybody trying to get a mortgage knows the challenges that there have been in the last few weeks. And let's hope that interest rates don't end up at 6%. Now, I really wouldn't want to have a job as an inflation forecaster at the current time. The Bank of England was doing a great job prior to the Ukraine crisis, forecasting 7% peak. It's pretty much the same graph. You just have to change the legend on the right-hand side, and you can now see that the Bank of England is now saying a 13% peak, but they daren't see inflation staying at that level, so we've got it nicely going back down to 2%. Well, nobody really knows, and I'm definitely not going to call it. The only thing I would say is we can hope that a lot of the increases that we've seen in energy prices have pushed through. Having said that, we'll show you in a moment what energy prices are looking like. This is natural gas prices, and you can see these three peaks that mark the part of the root of the current inflationary problem. You're going back to the tail end of last year, March this year, and then an even bigger one in September this year. And they say, well, thank goodness it's come back down to £235. This is Great British pounds per therm, old money for you if you like that. And you say, well, that's great, it's come down. However, if we look at the long-term average, we can see that at 230 odd, we're still way above the peak of 79 or 75, which is, so that's over 3 times what we would consider previous peaks in gas prices. So big challenges in terms of energy prices, both for businesses and consumers. We've got the energy price guarantee coming in. Jeremy Hunt's just trimmed that back. It will get us through the winter, but still at a high level. And everything is taking its toll on UK consumer confidence. And I sort of lost count of how many little red arrows I've got on here. We've got Brexit back in 2016 was the beginning of this dip in confidence. Then we had COVID, which created that huge valley. Then we had war from Russia invading Ukraine, and COL now stands for the general cost of living, which is really depressing the view of consumers on the future. So big challenge for consumer confidence in terms of what they are happy to spend and what they are thinking about the future. What about manufacturing confidence? Now, we've often found this UK Purchasing Managers Index to be quite optimistic, even in difficult times. We can see the dip there due to COVID on the right-hand side there, and then this wonderful optimistic aspect coming right up to 65 there quite recently. And then, of course, since then, it's been this huge drop down to, I think, 47.3, reflecting this contraction in the manufacturing sector. That little uptick at the end, I don't know what we can read into that. I mean, there are some contradictory findings in this data. New business has dropped for 4 months straight, and that includes new export business falling the most since May 2020. So there's rising uncertainty, there's inflation, there's the cost of living crisis, all weighing in on manufacturers. But employment has continued to rise, and that does suggest that capacity constraints have been holding back, companies holding back the UK economy in terms of its performance. And of course, that chimes with the GDP figures that I showed at the start. So what are the indicators that we need to be looking at? And at the end of this session, we'll show you some of the basket of indicators that we're pulling together from ONS to be able to monitor what is happening. And clearly there can be lags in the data, but what we're seeing here is total company insolvencies, that's the black line at the top, and then voluntary ones and compulsory ones, so largely voluntary. But we are seeing quite an uptick in company insolvencies. Now, our view at the current time is this is some of the zombie companies that were kept alive during COVID, which are finally being put to death. But the question is, you know, where are we relative to pre-COVID? We're now above that level. What's going to happen to this line? We'll be monitoring that very closely in the days that lie ahead to understand what is happening within the UK and the Welsh company base. Now, anybody remember Brexit? You couldn't get that out of the headlines for probably about 5 years, I think. It hasn't featured quite so much recently, and a very interesting piece of research by the Centre for Economic Policy Research, which is a network of about 1,500 academics across mainly European universities. And it's very interesting research on what have we seen so far. This research was undertaken in 2022, but a lot of the data is 2021, so already it's out of date. So we're hoping that they will update this. But impacts on consumer prices, trade, and migration are three things that have been researched in this publication. Now, this is what they say about consumer price impact: a significant short-run effect on consumer prices. So it was 6% in food due to Brexit in the 2 years to the end of 2021. And imports with high exposure to the EU, so that's things like fresh pork, tomatoes, and jams, they showed a larger price increase than those with low EU import shares. So tuna, exotic fruit, pineapple, they were relatively unaffected. And of course, food, as we all know, more affected than other products due to the perishability and its exposure to phytosanitary measures. And whether that's been used as barriers to trade or not, it's certainly been a problem. And companies getting used to the new import and export rules. But in general, they found this higher cost of trade pushing up consumer prices, and we'll just need to see how that beds in as we go forward. So that's consumer prices. What about trade impacts? Now, we showed a similar graph in our presentation in March, and it's very difficult to discern any drop-off. So when people talk about this drop-off in exports to the EU, there's no evidence of that in the trade. And the blue line at the bottom here, that's our exports to the EU, and our non-EU exports, it's just flatlining pretty much. Tiny uptick there, flatlining to the EU. We've seen some other things like machinery has jagged line, but generally going up. Food and live animals is generally static. So Anne Harrod, good economist as she is always keen to point out to me, well, you can't just look at those figures, look at the relative share of trade. And we actually see that the UK's share of EU goods imports has dropped from 11% to, that was in 2016, to 7% in 2021. And that's largely because China has moved in and grown its exports to the EU. But the most interesting aspect here, which the researchers found, was that effectively, although the total exports are pretty much staying the same, the number of export relationships has really dropped sharply. And their view is that the smaller companies have said, this is just too difficult now, it's not worth our time doing this, let's get out of the export market. But the bigger companies have been able to absorb any extra costs and adapt their business to continue exporting to the EU. And in 2020, of course, the UK was a big player in EU exports. And the other thing to mention, this is goods here, is services. And the UK is a top 3 services trading partner with 17 of the EU 27. And services is something that we also need to look at. It hasn't fallen off a cliff, but the EU is very determined that we'll lose our position in financial services. And so the challenge for the UK there is to find new opportunities in other markets, keep the EU going, perhaps develop further with the US. And so in this slide, we see a comparison of goods and services exports. And you can see that services is almost as much in the 12 months to July 2022, services almost as much as goods, and very important for the UK's economic recovery. And then lastly on Brexit, then the migration impacts. And of course, if you've been trying to get staff for your business, then you'll know all about this. It's fair to say that the pre-Brexit view was that, you know, ending free movement would reduce growth, have a negative impact on the public finances. But in actual fact, what's happening is that UK migration is being rebalanced away from anybody in the EU to people required by the UK economy from anywhere. And whether that works in the long term remains to be seen. But of course, in the short term, there are issues for lower skilled, lower paid occupations, and they may no longer gain entry to the UK unless there are specific needs. And of course, that does include agriculture, food and drink, hospitality facing challenges, because the UK economy will grow more with healthcare and ICT. That's the challenge that we face. And of course, employers are having to work with a new system facing upfront costs and completing paperwork and being able to process migrant applications. So the visa route for agriculture in 2021, there were EU citizens holding 13,000 jobs fewer in agriculture than 2 years earlier. But at the same time, agricultural employers pretty much exhausted the seasonal workers visa, taking up the 30,000 places. Lower sponsorship rates in other sectors. So it's hard to see how this is going to bed down as we move forward. It's definitely additional admin, additional costs set up, but will it have the effect of improving the productivity of the UK economy? And of course, the challenge for the food and drink sector is to increase pay and conditions to attract staff and or to invest in more training and automation. And if you want to invest in training and automation, that costs, and pressure on margins may actually restrict the ability of companies to do that. So lastly, we're developing this indicator set, as we said, and we'll be monitoring this. Now, these different data sets report on different frequencies, but ONS pulls them together. So we've selected some of ONS's indicators so we can continue to monitor the top left, what's happening to online job adverts, what's happening to potential redundancies and employers proposing redundancies, what's happening to new company formations, what's happening to voluntary liquidations, what's happening to consumer spending on debit and credit cards, what's happening in the out-of-home sector and restaurants. It's interesting to see that still holding up there. It's almost as if consumers are saying, well, I really do not want to give this up, so give me some deals in the out-of-home sector and I'll keep coming. We've got employment at the UK level, we've got unemployment, and we're going to add perhaps a few more indicators to this and be able to sort of report these on 1 or 2 pages to help keep people informed of what is happening in the economy. And as I say, some of this is lag data, so it finds out what's happening a little bit after the event. It just depends on the different data sets, but we have to work with what's available. So thank you for listening. That's the end of the economic review, and I'm going to hand over now to Anne Harrod, who's going to take us through what are shoppers doing in response to everything that I have just reported.
Hi, thanks for that, Donald. Yeah, so as Donald said, I'm going to look in a bit more detail about what it means to consumers and the food and drink markets. So if we start by reviewing the consumer prices, as shown by the, Donald, can you ping my slides on for me? Thanks. Yeah. So we will start by looking at consumer prices, and this graph captures retail price index, which shows that over the last year, we've seen sort of prices increase. And in August 2022, it was 12.3% higher, with the cost of utilities, which is shown in the light blue, being the major factor reflecting the increased energy prices that Donald was talking about. Additionally, whilst food and drink is a much smaller contributor to the overall growth, this is also accelerated, and it's shown by the orange segment here. And these increases in non-discretionary areas of consumer spending means that there's very little that households can do to avoid the increase in prices. And, you know, as Donald was mentioning, as interest rates are increasing, this will further exacerbate challenges faced by households as sort of mortgage costs and cost of borrowing are set to increase, putting further pressure on them. More recently, if we focus on fast-moving consumer goods, we see the inflation here is at 12.4% in the beginning of September. Kantar have just recently updated this figure and showing that it's now at a staggering 13.9% as supply chain costs are being pushed through to consumers. And shoppers are responding to the price increases by buying less volume. So whilst total market spend is up, it's lower than that rate of inflation because the total volume is falling as shoppers respond to the price increases. If we go back to August, we see that the decrease in volume purchases is actually amplified in Wales. So there's a much bigger drop in that volume purchases relative to GB. And that is sort of squeezing the growth in the total value increase to 3.54% back in August. And as the inflationary pressures and economic concerns are increasing, it's also sort of driving an increase in the proportion of households that self-report as struggling. And that's increased by 6% since last November to 24% of the GB households. So that's almost a quarter of the GB household population saying they're struggling to make ends meet. And similarly, those feeling comfortable and not needing to restrict their spending has also fallen from 41% back last year to 33% by September 2022. So that's sort of just a third of GB households in that comfortable position. And in responding to the inflationary pressures, shoppers are buying less, as I said, but also trading down, with trading down absorbing 2.6% of that change in value. So looking to reduce what they spend. And if we kind of look at inflation as a whole, we sort of also see that inflation is impacting poorer households more strongly than the GB average. So this is sort of capturing the varying rates of inflation by household type over the summer. And we see sort of by August, the poorest households had a personal inflation rate at 2% points higher than the average. And there's a sort of question about why households face different inflation rates. And if you think about sort of the basket of goods that sort of reflects inflation, there are a difference between the price of branded goods, of premium and more basic ranges. And the reality is that the poorer households have been looking to reduce their spend over many years, adopting coping strategies and trading down, shopping around. And this means that their baskets are disproportionately focused on the least expensive versions of products. And in the current crisis, these low margin products have no scope to absorb the increased supply chain costs that are being felt. So more of the price rises are being passed on to the consumers, and therefore their basket of goods have a greater inflationary level. And we're seeing this particularly in the commodity items, have a steeper price increases, and the shoppers who are most dependent on these have greater inflationary levels. If we move on, please. So if we look at the effects of consumer behaviour more broadly, the exact same items purchased today are £49 per month more expensive than they were in September 2019. However, shoppers are spending £37 more and avoiding £4 per month less by buying less volume and avoiding £8 less by buying a cheaper mix of products. So the impact of trading down and sort of why retailers are becoming so interested in own brand, a clear sign here. And back in August, own brand accounted for over half of retail sales by value. This is the highest level recorded by Kantar outside, and it's outside of the peak own brand months of January and February, when household budgets are at their tightest. And there are two key factors that are driving this massive growth in the value of sales in own brand. Firstly, the trading down that I sort of showed earlier, but also the growth that we've seen in the discounters, Aldi and Lidl, and their growth in market share, and they're sort of dominated by own brand labels. And Sophie will cover that in more detail. So if we can see this further by the value of growth in own label in the basic range, it's up a third, an increase of 62 million over the 4 weeks to September. And whilst this is from a relatively small base, the rate of growth has outpaced premium own label and brands in cash terms. And from a sort of Welsh perspective, I think it's worth remembering that Wales has got quite a strong capabilities in own brand manufacturing production, and the sort of shift towards own brand might be sort of one area of silver lining to the Welsh industry in the current market. It's also worth bearing in mind that despite the very strong growth in value owned label and the increase in households cutting back on costs, we have to remember that the grocery retail market is highly diverse with a wide range of factors driving shopper choices. So if we look across all households, so the comfortable, managing and struggling, we see that shoppers are buying brands, but they're buying premium owned labels, standard tiers, as well as value owned label. So while struggling households spend proportionately less on the premium and branded and a bit more on budget lines, these are only sort of small differences compared to those who are comfortable and managing. So for the food and drink industry, whilst obviously having to respond to shopper price pressures, you have to kind of remember not to lose sight of all the drivers that encourage shoppers to spend, and factors such as sort of quality and provenance and innovation, practicality, enjoyment, health, etc., are all part of the equation. And sort of being really mindful that cutting costs at the expense of these attributes may damage sort of shopper loyalty and their desire to purchase the product. And I think in this sort of period of extreme price pressures, that the industry also needs to stay very awake to issues around food fraud and supply chain security as you secure products. So thank you very much for that. I'm going to pass on over to Sophie now, who's going to draw out the implications to the retail sector.
Thanks, Angharad. I'm just going to share my screen separately, if that's all right. Hopefully that will let me do that. Okay. Can you just give me a hands up to see that? Should be fine. Actually, it's not quite worked the way I wanted it to work. Sorry, it's just hidden my notes. I'm just going to stop that for a second and try again. We can always edit that a bit later. So thank you very much, Angharad and Donald. I'm going to talk about then the implications for out of home and the retail market as a result of this shopper behaviour stuff that we're seeing. Firstly, let's start with out of home. So if we look at the IGD's forecast for the year in total out of home, they talk about the market being worth £41.8 billion this year, up versus last year, but of course nowhere near the pre-COVID levels. I think there is some thought that actually performance is slightly better than that. However, it's still unlikely to be matching 2019 levels. And if you then speak to CGA, who measure the on-trade, so the drink side of the marketplace, and look at what the performance of the market looks like that, you can see that over 2 years, we've seen a huge number of sites close. So since 2019, 10% of sites have closed from food-led outlets. Drink-led outlets, 6% of sites have closed, and accommodation-led outlets, 9% of outlets have closed. And of course, there have been a couple of big reasons behind that. Obviously, COVID has made the hugest difference, and the sectors that have been most affected by that has been nightclubs and that sort of area, significant closures in that area. And the other thing that I think is important about this is that the casual dining sector has also significantly declined. There was a lot of talk pre-COVID, actually that sector was already struggling and was overexpanded. And we can see numbers of franchisees and outlets significantly falling back. But if you then look at the latest CGA data, and this is, they look at like-for-like data across 70 operators, which captures about £12 billion worth of sales. And this is like for like versus 2019, so pre-pandemic. You can actually see the sales of alcohol or drinks in total is actually tracking up most of the year, in fact, all the year pretty much. And then there's a big spike of nearly 20% in the Jubilee time. And then more recently, something like 4.5% to 5% growth at the end of August. And if you ask, and also they run a survey, they talk about profitability, and 88% of outlets are saying that they're in profit, 10% are saying they're breaking even, and only 2% are saying they're losing money. But we know that they're also experiencing huge cost increase, with their energy costs going from something like 5 to 18% of turnover. And we're also at the time of year where we're just about to enter what they call the golden quarter. It's the quarter where out of home makes its most money, something like a third to a half of profits. And we've just talked a lot about what's happening with shoppers' baskets and the pressure of costs on consumers. So anytime that happens, normally we would expect a downtrade in out of home. Normally we would expect people to move from out of home in home. So I expect this next quarter to be a really big indicator of whether people are going to still try and treat themselves or not, and what happens in the out of home. My expectation is it's going to get tougher, and I think that it's likely that we'll see some declines coming through. In terms of retail, I've got 3 charts I want to talk about in terms of retail and market share. I've got 52 weeks GB. I'm then going to talk about the Wales picture, and then I want to briefly talk about the latest 12 weeks position. Firstly, this is data to the end of September. So 52 weeks, the grocery market was tracking at about 2% down, still some COVID stuff going on in here. The big points to really pick out here is Tesco's doing better than the other big 4, and I'm going to qualify the big 4 statement later, significantly better. And the rise in discounters now 7 to 8% growth on an annual basis. And really, if we think about what Aldi, where Aldi's at on that, is they've had massive growth. But what's quite interesting about Aldi, if you look at their numbers, their profitability's dropped significantly. They're about a fifth the size of Tesco, but their profitability has gone from something like 2.1% last year to 0.44% this year. So a profit number of around 280 million down to 60 million. So they are really investing in price for the long game. They're really investing in trying to get to new shoppers. I'm going to talk about that a bit more later on. And then if you look at that conversely, say Tesco, who've also been doing pretty well, Tesco's actual net margin is down. They've lost 10% in margin this year, but they're also still trading at 4.6% net profitability. So they've still got lots of money in their armory potentially to try and continue to fight the discounters. However, the discounters are on significant growth. The other big standout here is what's happening with Marks and Spencer's. So Marks and Spencer's are showing 3% growth. Which is pretty significant. Yes, they had a bad COVID, but actually still they're showing 3% growth and doing significantly better than, say, someone like Waitrose. And again, I'm going to talk about M&S a bit later on. If we look at Wales, of course, we know that the Wales market is different. The setup is different. Tesco's the #1 player still, but nearly 30% of the market, so 29.1% of the market, as does #2 with 14.6%. And the 2 discounters, Aldi and Lidl, are combined are bigger than Asda. And if you look at the performance, again, some of it mirrors what we see in GB. So Tesco is doing significantly better than Asda, Sainsbury's, and particularly Morrison's, who are having a torrid time. I'm going to talk about them in a sec. Co-op's having a particularly good year this year in Wales after a bad year last year. And Aldi and Lidl, although Lidl looks like they're doing badly, last year they had a very good year. So if you looked at like a 2-year combination, they're both in growth. And again in Wales, M&S is outperforming the market, 4% growth. So significant performance for Marks and Spencer's. I think more interesting is when we start to look at this latest 12 weeks data. And because we're starting to sort of get rid of some of the COVID effect, if you like. We're seeing the market's up 3%. Tesco is now not in line with the market in terms of growth. They have been performing phenomenally well over the year. They've gained share over the whole year through a number of strategies like their club card pricing. And in fact, you can monitor their share gain for when they did their club card promotions. And of course, now they're really doing Aldi price matching. Morrison's is the standout retailer, doing really poorly, down 4.8%. And actually Aldi's now, this latest 12 week, become the #4 retailer, overtaking Morrison's, which is really significant. Iceland have had a good time because of what they've been doing, because of their value proposition, but also they've been doing their Pensioners' Day, which has significantly increased footfall. And Aldi and Lidl are just going like a train, 20% up for Aldi and 22% up for Lidl. Aldi shouting about they've attracted 1.5 million more customers in the latest 12 weeks, which is huge. And you've got to remember that shoppers don't shop in just one retailer. On average, they're shopping in 4 or 5. So even if they're going to Tesco, they're probably going to Aldi. So why Tesco is so, and all the other retailers are so obsessed about that, is they know that as well as shopping where they're shopping with Tesco, they're going to be shopping in Aldi. Something like 2/3 of the households go into Aldi at some point. Now they've got some pretty significant household penetration. And lastly on this slide, M&S is still growing, which I think, although it's not as fast as the market, is still significant performance in these really tricky times. So I suppose the big thing is price. And if you go into retails, everywhere you go, as you see price. And if you look at Tesco on the left-hand side, you can see there, they're really talking about how they're matching Aldi. In fact, if you go around their stores, they're even highlighting SKUs where they've Aldi price matched to try and sort of reassure shoppers that they don't have to go to Aldi to do their main shop. They can do their main shop in Tesco and buy all the other bits that they like. They are losing some sales to Aldi, but I think they're not losing them as fast, certainly as, for example, as Morrison's. And everybody else is doing similar things. So we've got Sainsbury's here talking about price lock, and we've got M&S talking about price lock and also remarkable value. So everybody in their own way is talking about price. But I think that prices, it's not just about prices. We know about brands, it's about value, and value is price times quality. And I think that also opens up opportunities for brands. And I think just want to share with you one sort of scenario, if you like. So if you look at this is, say, the Asda sausage category, and you can see Edwards, the £2.75 iconic Welsh brand, premium price position, and you'd expect, and I'm sure there will be, some trade into cheaper options. So some trades into Asda own label at 150, and then some further trade down as the Just Essentials range at 96p. But I think there are still two opportunities for premium brands here. One is to get to trade shoppers into cheaper occasions for the same time of day or the same week. So maybe a Friday night occasion, rather than being a steak and chips occasion, becomes a sausage and a mash occasion, a significantly cheaper occasion, and potentially something that a premium brand like Edwards could talk about. But possibly the bigger opportunity in retail is this shift from out of home. So if you eat out on a Friday night and you have sausage and mash, it's going to cost you on average £10.50. If you eat in home, it's going to be like half a pack of sausages and some mash, somewhere around £1.50. So it's something like 15% of the cost. So there's a really big saving for shoppers eating in the home. And as a result of that, I think there are opportunities for trying to encourage out-of-home experiences in home and trying to tap into that with premium brands. The other thing I want to talk about in terms of premiumness is M&S. So this is M&S, one of their I think they call their renewable stores. And this is actually the one in Marble Arch, near Marble Arch in London. And I was really super impressed when I looked around this store last week about how differentiated it feels to all the other retailers out there. It feels a very different place. You feel like it's giving you a real experience when you go there, and really strong on their messaging. Officially the best place to buy beer, officially the best place to buy pizza, voted the best supermarket, really reassuring shoppers about their premium proposition, but also talking about value at the same time. And I actually think that even the whole store feels color coordinated. All the designs feel color coordinated, even all those gondola ends. It's really phenomenal what they have done and how they've differentiated them. And no wonder they're actually holding share. And the last picture on the right hand side you can see is M&S friendly fishing. So even whatever is core about the category and their differentiated proposition of that category, they're talking about. So it shows that value is definitely about quality times price, and shoppers value that. And I couldn't be talking about retail without talking about HFSS, high fat, sugar and salt. It is the biggest change in retail in 20 years. It has been watered down a bit, but it is still being implemented by certainly Tesco and Sainsbury's in a very big way, and then also across most of the major other retailers. This is Sainsbury's. What is really interesting about here is they've got 3 end displays just on toys coming up to Christmas. Normally some of that would be food or alcohol, but it's now toys. The second thing that's really interesting is this particular thing. So it's a poster rather than a gondola end. So they've got rid of the gondola end and they've put a poster up, and obviously it's being paid for by walkers, I'm sure, huge amounts of money. What was quite interesting about this particular store is where it said find us in the crisps and snacks aisle with the arrow, that pointed the direction to the confectionery aisle. So it wasn't perfectly placed. And round the corner is how they're doing the new gondola end, if you like. Round the corner is the great pie prices, which is within aisle, which is all the confectionery items that they want to promote, and heavily. And then, of course, they're really championing with the big manufacturers about more block space, particularly for people like Cadbury's. Are taking a whole, that's just dairy milk. It's got flag banners and all that sort of stuff going on. I think that poses some challenges for suppliers in this category, because obviously there's going to be less space in the aisle. So therefore getting your slot and making sure that you have a point of difference is going to be a bit more challenging. The other point I want to talk about HFS is really this whole start of reformulation. So this gondola end display is in Tesco. You can see that it's got Sorin on there, and also Mr. Kipling cakes. And the Sorin is HFS compliant, and the Mr. Kipling cakes are their Better For You range, where they've moved their nutrient profile score from something like 25 down to 3. So what they're obviously what retailers are looking for is HFS compliant things of some of the consumers' favorite brands, but it also opens an opportunity for new brands that are HFS compliant. I suppose about 4 years ago, we saw the launch of Halo Top in terms of in terms of the thoughts around reformulation. They were really revolutionary. A whole tub of ice cream for 320 calories versus something like Ben & Jerry's, which would be more than 1,000 calories for the same tub of ice cream. They created a significant market share and a significant brand. We've got Mars launching a range of what they call treat products, and they've done it across their whole brand. They've done it for Galaxy, Mars, Bounty and Snickers. I think the jury's out about how great they taste and whether or not they're going to really deliver, but they have launched, and they did a huge launch in Sainsbury's about 2 months ago. And then I think this is a really interesting innovation. So this is a brand called Urban Legend. It's a donut brand that is steamed and not deep fried, steam baked, not deep fried, and they've got an IP on the technology. It's been launched by, or involved in the launches by, Anthony Fletcher, who launched Innocent Drinks and also Gray's. And this displays in Selfridges. But what they talk about is donut brand that tastes great, that is never high in fat, never high in sugar, and never high in calories. And for me, this is the start of the reformulation piece that's coming, and how brands are going to respond and compete in those areas. I think some of them will fail and some will succeed, but will be interesting to see how that plays out. So I just want to finish on sort of 4 key things. One is shoppers are moving spend to cheaper retailers. We've been talking about that. And all the retailers are talking about value, but let's all remember that value is just not about price. Value is about quality times price, and holding that quality is really important for our brand credentials, because if we move that dial, then what are we going to compete on potentially? The second thing is the other retailers are absolutely obsessed about losing to discounters. They're obsessed about losing shoppers to Aldi and Lidl. So anything that we can do, or anything that we're talking to them about, a strategy that might help them keep shoppers, whether that is the fact that because it's Welsh and this discounter's not doing a good Welsh range, it might attract a few shoppers, you know, or because actually we can provide them with an own label solution versus a brand that can give them a better price point. All those things that we could potentially talk about, I think, are quite important to think about now. And the third thing is that M&S really prove that quality and delivering experience, and experience really is what is at heart of that store visit, and value can deliver growth. So it's not a time to throw the baby out with the bathwater. And finally, HFSS is the biggest change in retail currently. It may be diluted, and we don't know how far it's going to go. Gondola End currently activity is really different, and we'll have an update on HFSS in January. And the third thing to say about that, or the last thing to say about that, is healthier is definitely on the agenda. And we as the Insight Programme are really conscious of that, and we're working out a piece of insight, a piece of work for next year to talk about health and healthier, and how companies we may be able to help companies on some of that journey. That's it from me. I'm going to pass back to Donald, who's going to summarise for us.
Thank you, Sophie, and thank you, and Harrod, for taking us through that. So really just 4 things to say in terms of the food and drink sector implications. You know this, cost management. Capital's been added in there now because of the change that we've seen in interest rates. I don't know what your banks are saying to you about borrowing costs. Energy was already in there, labour, ingredients, and of course then product margins. So cost management, the first thing, supply chain security. This is a prime time for supply chain fraud, food fraud. And Welsh companies really need to be absolutely on that in terms of where are ingredients coming from, are suppliers audited, do we know this is genuine, to protect reputations at this time when there'll be lots of pressure to be fraudulent. And then, of course, continue the customer price conversations. Everybody's doing it. Everybody's putting through price increases. If you haven't put that through, then continue that conversation with your customers and plan for that continued cost uncertainty for at least the next 6 months. And lastly, demonstrate value to consumers. So as Sophie was saying, it's not just about being cheap. It's not just about this price focus. Make sure you've got a value proposition that gives reasons to buy your product and that you can demonstrate that to your retailer customers. And so in summary then, in our final slide, food and drink is an essential sector, but within the overall economy, it's a small part of the government's play for economic growth. So we are going to have to fight for attention as a relatively small sector, a sector that's perceived as having low wages, low productivity, low margins. We need to tackle that with innovation. It doesn't always have to cost, but the likelihood is capital investment is required. And of course, that's tough as the cost of capital rises. So we all know that navigating this difficult market continues to be very difficult. And what we need is a consumer focus on value, practicality, enjoyment. And that means that both staple and necessity items and luxuries have scope to win. So both ends of the market, if you like, can win. Shoppers are looking to save on big ticket items, but they're also looking for pleasure and escapism within food and drink. So thank you very much for your attention this morning. It's been fantastic to be able to present to you, and I shall hand back to John now if there are any questions. Thank you.
John, shall I come in there? There is one question from our John, John Taylorson. John, do you want to pose your question, but also maybe talk very briefly about some of the work, you know, that we are doing within the cluster that can help the businesses on the call?
Brilliant, thank you. 3 great presentations. Thank you very much indeed. The question that perhaps was to Sophie on out of home, I didn't know if we captured what coffee shops were doing, thinking about the bakery, dairy, and the coffee suppliers that we're supporting.
That's a good question. I don't know the answer to that currently. I don't know what their performance is looking like. We do buy an annual update from Kantar, which will be available next February, so it is a few months off. However, I'm pretty sure we can probably go away and find some stuff around that. So we'll put that down as an action for us.
Brilliant, yeah, thank you. I mean, it's a real bellwether for food and drink. Just to talk about
I was just going to say, sorry, we did have a stat saying, I think, and Harrod, you had this, about 2/3 of footfall was where things were sort of ending up with this working from home being embedded as a norm, but not a complete norm. And therefore, I think just in terms of that type of outlet, location is very important, that if you're in a transit hub, or if you're in city centre London, then trade is probably down. But as Sophie says, we will have some specific data on how that looks in February.
Definitely work from home has made a big difference. We have got some stuff around that, which I can show.
Brilliant. Thanks, Donald. Just on the sustainable scale up, obviously we've been concentrating for the last 2 years now, sort of on the 3 key areas for people who are trying to scale and or recover from the COVID: capital, capacity and competency. And one of the things that was really struck me about the presentations was this issue about availability of labour and the amount of capacity that's available. And some of the people we're talking to are looking at, can they switch to where they're seeing their volumes drop, switch to contract packing for other people, and or sort of collaborating more to ensure that they've got fully utilised lines and that they can get their products from other people. And that's one area I think we're very keen to support people if they want to investigate that further, both in terms of what is it actually costing to produce, can you get it done by somebody else to sort of get better utilisation, and also have you got your cost recovery in terms of overheads. As volumes are dropping, people are finding that they're not being able to get through the price increases that Donald was talking about, and yet their overheads have increased. So it's becoming doubly important to actually capture those overhead costs and see where they're being recovered over individual product lines.
Okay, thanks, John. We've got a question from Miriam. What are you anticipating for Christmas trading, both in and out of their home? Might there be a hedonistic boom when people have reached peak doom? Brilliant question.
So my thought from what people are saying on the retail world is that they think it's going to be a very tough Christmas, actually. They think the year on, of course, there'll be a peak, but it will be potentially lower than last year. And price will be very important. In fact, I have seen an advert, I think it was in the Grocer this week or somewhere with this week, where someone's already doing the value Christmas end where they had frozen turkeys on. So I think it is going to be, it doesn't mean people won't treat them. It doesn't mean there isn't still a market, but it's not, I think Christmas is not predicted to be as good as previous years.
I think also that last Christmas, coming out of COVID, people were sort of pushing the boat out because they'd kind of missed those sort of family occasions. So in reflecting on that year-to-year change, it sort of it doesn't sound, you know, I quite like coming out of peak doom, but sadly I don't think. And I think the sort of, you know, how the out-of-home market and office parties and things, maybe they'll be back on the cards, but I don't know.
Another question just about, will we be sharing the slides? I assume the answer to that is yes, so we'll get those out. Question from Reese, is the Football World Cup expected to boost out of home and possibly impacting Christmas?
I understand that, yeah, that most retailers are planning for, retailers certainly and out of home will be planning hard for Football World Cup. It normally generates a significant amount of spend. The timing of the matches, I think, are predominantly morning though, so there's a lot of breakfast stuff people are talking about doing, and even breakfast ends and things like that going on. So I think there will be a boost. Will it take out of Christmas? I don't know. I think it's probably going to be a bit incremental, actually.
Okay, from Carrie, do you think that low alcohol, no alcohol products may become more attractive to consumers with the increase of healthier options?
Short answer, in general, low and no alcohol is growing. Just so there is a webinar on low and no alcohol specifically, I think it's on the 17th of November, where we've got the food people talking about the low and no alcohol trends. And also we've got Philip Montgomery from CGA talking about the market in alcohol plus what's happening in low and no alcohol. So come along to that, it's in a couple of weeks.
Yeah, and also we've got the MEP, the minimum unit pricing impacts having an effect in Wales. So whether that's sort of encouraging people to switch from high alcohol to low alcohol products in response to the sort of tax effect, then that's also quite interesting.
I think that's the last of the questions in chat. Has anybody got any other points that they want to make?
The only other thing I think is we've got so many suppliers on the call. I think it'd be worth mentioning Carry Glass next year. It's going to be a really big campaign. I think there is significant government support. So please get involved if you can, because I think it is one of the opportunities where we can get impact in retailer and out of home, especially if we do it collaboratively.
Thank you to Donald, Sophie and Harrod. I thought that was really, really insightful. Thank you. And it's been great to see so many people have been able to stay on and ask questions. So have a very good rest of the morning. And don't forget, if for any of the businesses, if you want to get in contact with us, I put all the email addresses in the chat section. So please do get in touch. Thank you all.